If you own a property in Canada, the fun part is being able to deduct many different things on your statement of rental income. The not so fun part is when the CRA decides to deny it or adjust it. In this video, I'm going to talk about the most common 5 mistakes that people make when doing their statement of rental income. Starting with mistake number 1, we are writing off personal use like it's 100% rental. Okay, what does that mean? So that means that you have personal portion of total expenses. So let's say you own a home, but you are only renting out one half of it, 50% of it. You're only renting the downstairs, okay? You are not able to deduct 100% of the expenses. You can only deduct the expenses related to that one half. So if you look at the CRA website, they have an example here where they say, if you rent part of the building where you live, you can claim the amount of your expenses that relate to the rented area of the building. You have to divide these expenses that relate to the whole property between your personal part and the rented area. And then they have a really good example here where it says, if you rent 4 rooms of your 10-room house, you can deduct 100% of the expenses that relate only to the rented room, such as repairs and maintenance, plus 4 out of the 10 rooms of the expenses that relate to the whole building, such as taxes and insurance. So what are they saying here? They're pretty much saying if you rent it and you have expenses related just to the downstairs or the basement, you can deduct 100% of it. But if you have some common expenses for the whole house, such as property tax or insurance or whatever, then you can only deduct a portion of it, so 40% in this case. So before we get into mistake number 2, just to quickly see the CRA website, you see they have a archive page just saying, making sure that you have to pay taxes on your rental income, which I think is funny. And then they give you examples. So if you're renting out a bedroom, a basement, or a condo, or a house you own, you have to report it and pay tax on that. These snippets are coming from the CRA government website, rental income. So they have a whole guide here about how to do your rental income, what you should report, what you can't report, what expenses are allowed, what income you must report, etc. So you can go through this guide on your own. In my video now, I just posted a few snippets of it directly from there to help you. So mistake number 2 is confusing repairs with renovations, okay? So the thing here is not knowing whether it is capital in nature or a current expense. Okay, so if it is a current expense or a repair and maintenance, you can deduct 100% of it right away. If it's capital in nature, you have to take depreciation on it. So renovations are expenses that extend the useful life of your property or improve it beyond its original condition and are usually capital expenses. So it has to improve it beyond its original condition. So if you're changing, let's say, the roof of your house, that's going to extend the life of your home for, let's say, another 25 years. That would be capital in nature, okay? But if you're repainting the outside of your home, that'll only last, let's say, a year or 2. It's not going to be there for many different years. It's only going to be there for 1 year, let's say, and then you have to repaint it. That would be a repair or maintenance, okay? So they tell you here, and they give you a criteria that you can look at and determine whether it is capital or current. So it says here, however, an increase in property market's value because of an expense is not a major factor in deciding. To decide whether an amount is current or capital, you must consider the following and answer them. So does the expense provide a lasting benefit? So if a capital expense generates a lasting benefit or advantage, for example, the cost of putting vinyl on the outside of your wooden house is capital. A current expense is one that usually recurs after a short period. For example, the cost of painting the exterior of a wooden house is a current expense. So if you had to repaint the home, that would be a current repairs and maintenance expense. You deduct a whole 100%. If you are putting vinyl on the outside of the house, that is capital. It'll improve the lifelong lasting benefit of the home. Does the expense maintain or improve the property? So the cost of a property improves the property beyond its original condition is probably capital. If you replace wooden steps with concrete steps, the cost is capital. However, it says here, an expense that simply restores a property to its original condition is a current expense. For example, the cost of repairing wooden steps is a current expense. So if you had, for example, wooden steps already in place and you just tried to repair them, that would be considered current because you're just repairing it back into its original condition. If, however, you put cement, that would probably increase the life of the steps for another 10, 20 years. So it's capital in nature. So a lot of people get confused with repairs and maintenance and always deducting it as repairs and maintenance, because that is better for you in terms of for the tax year, deduct a whole 100% rather than taking depreciation on it. Mistake number 3, so claiming mortgage payments instead of interest only. So if, for example, you have a mortgage, so it's not you don't own the house yourself, you didn't pay it with cash, you took a loan from a bank, then you can claim interest payments only. Okay, so there's a line on the T776 statement of mortgage interest, line 8710, interest and bank charges. So you can deduct the interest charge on money you borrow to buy or improve your rental property. If you have interest expenses that relate to the construction, okay, we're not going to talk about that. In general, if you have a mortgage that you're renting out a place, you can take interest on that mortgage and deduct it, but you cannot take your principal as well. So that's why your bank sends you a statement in the mail claiming how much interest you paid and how much principal you paid each year, so that you can report it on your T776. So mistake number 4 here is CCA depreciation used without a plan. So CCA cannot create or add to a loss, a rental loss, okay? So the thing about CCA is you don't have to take it in the year. You can take it in the next year or the following year. So here, if you read, it says here, you might acquire a depreciable property, building, furniture, whatever, to use in your rental activities. You cannot deduct the cost of the property when you calculate your net rental income for the year. However, since these properties may wear out, become obsolete over time, you can deduct their cost over a period of several years. Deduction is called CCA. So because you're wearing out these things, they're allowing you to take a percentage of a deduction each year instead of the whole 100%. So let's say you bought furniture for it lasts 5 years, then you take 20%. However, there are specific rules relating to what the percentage is based on the class, okay? But anyways, you go down here and it says you do not have to claim the maximum amount of CCA in any given year. You can claim any amount you like from 0 to the maximum allowed for the year. If you do not have to pay income tax for the year, you may not want to claim CCA. Claiming CCA reduces the balance of the class by the amount of CCA claimed, and as a result, the amount of CCA available for you to claim in the future years will be reduced. So if you're at a loss or you're at 0, you do not want to claim the CCA. You're going to have to click a checkbox in your T776 software, in your tax software that you're using. Do not claim CCA. Don't let them go to waste. When you are, and if you are in an income position, then you will claim it. Number 5, forgetting to report all the rental income. So again, what if, your tenant pays you, but not with cash. They pay you with some sort of service or good. Maybe they do marketing for your business, whatever. You must show that as income. You can't just look at cash received as income. You have to include cash or check, kinds, goods or commodities, and services. So if your tenant pays you in cash, include the total amount. If they pay you with some other service, report their fair market value. So you would look at how much are they usually charging for their marketing service for your business. For example, what would be the fair market value it would charge you? You would add that as income and you would be taxed on that as well. So make sure not to forget all your rental income to be reported. And the last mistake here is poor records and figuring it out later. You don't want to have this problem where you're not keeping track of everything and you don't have the receipts. Remember, if you get audited, you must show them the receipts of those, let's say, everything that you have, repairs and maintenance, property tax, insurance, utilities, anything that you have related to your rental income or rental property that you're deducting, you must show the expenses. So in here, they say keeping detailed records of all rental income you earn and expenses you incur. You have to support your purchases and operating expenses with invoices, receipts, contracts, and other supporting documents. You do not need to send your records with your tax return. Keep them in case we ask to see them. We may not allow all or part of your expenses if you do not have receipts or other documents to support them. So essentially, these are the 5 biggest mistakes that people make and the most common mistakes I see. Again, if you are interested in looking at the whole publication related to rental income, I would suggest you go to the CRA website. Here you can see everything related to the rental income that they have. Again, remember the CRA they have these publications for you to learn, again, that you can actually do your own rental income, and you can show it on your tax return. If you are doing your tax return, remember it's T776. That is the statement of rental income. Very straightforward. If you have you have to fill out your identification, any co-owners or partners, show your income, and then show all your expenses here, and it'll just flow through and go into your T1. Not very difficult. If you are planning on doing your tax return, I suggest using Wealthsimple Tax. That is the tax software that I use. I think it is the most user friendly. You can click the link in the description. If you fund your account, you get $25, which is very great. And again, if you did enjoy this video, make sure to subscribe for more Canadian practical tax guidance videos. Remember, this is general information and not personalized tax advice.